Hello again at the Centre for Economic Policy Research. We bring you the most important new research on the economic impact of COVID-19. My name is Tim Phillips. What do we do to keep firms from going out of business at the moment? In many countries, governments have guaranteed bank loans to firms that otherwise wouldn't survive. But was this necessary? Was it efficient? And will it continue to be important if there is a second wave of the pandemic? Well, that's the theme of a paper that we published in COVID Economics 35, which outlines a way to estimate firm liquidity needs. And it's a method that's already been used to evaluate policy in Europe. Fabiano Schivardi of Luis University, also the CEPR, is one of the authors, and he joins us today. Fabiano, welcome.
Thank you. Hi, Tim. It's a pleasure to be here.
Why shouldn't we, Fabiano, just let creative destruction take its course during this pandemic?
First of all, let me say that, this work is joint work. It's based on the paper you mentioned, which is joint work with Guido Romano, who's the head of a research team at Cerved, and the data provider. They really supplied an important piece to this work. So going back to your question, there is a sharp difference between being insolvent, and that means you are basically, economically not viable anymore. You are, we say zombie firm, a firm that should actually die to let resources used in that firm to be actually put to better uses, and to be illiquid. Being illiquid means that you are actually solvent. You still have something to give to the economy, but due to some contingency, at the moment you run out of liquidity. And of course, this contingency during this pandemic showed up big time because for many very good and solvent firms, what happened is that sales basically dropped by a big amount. For some of them, even to zero if they had during the shutdown. And so your income goes to zero. Maybe some of your costs don't. That means that you might actually deplete your liquidity little by little, and at some point you run out of it. And in that case, maybe you're still solvent, meaning that you have assets that could actually be used to pay your liquidity, but you cannot do it in such short period of time. And in that case, I think it makes a lot of sense to help these firms to cover their liquidity shortages, because one thing that this crisis has been very, very deep and very, very sharp. But hopefully, what we all hope for is that it will be sort of a V recession, that we went down very sharply. Hopefully, it will rebound as sharply. But of course, if many firms go bankrupt, this is not going to be the case, because reallocating assets and workers takes time. And so we should really try to avoid firms that are solvent but illiquid to go bankrupt if we don't want the effects of this crisis to become really permanent, or if not permanent, much more persistent that they could actually be if these firms are actually, they don't go bankrupt.
Now, in Italy, where you are, and in the UK, where I am, the government has given these loan guarantees to firms. Has this been the pattern in a lot of economies?
Yeah, that's there is a very clear answer to this question. The OECD runs a policy survey. They keep updating what happens in different countries. And already as of end of April, out of 54 countries they had surveyed, they found out that 52 had some sort of government loan guarantees targeted to SMEs, to small and medium-sized enterprises. So I think, given what I said, it makes a lot of sense. And indeed, it looks like basically all governments have set up some sort of guarantees for bank loans to firms.
Now, the sums involved in this are huge, but of course there has to be some kind of limit. What would be the problem if we found out that these liquidity guarantees were still not enough?
So that's exactly the reason I worked on this methodology that we're going to talk about, because at some point the Italian government, or many governments somehow said we are going to do whatever it takes to avoid liquidity crisis to turn into bankruptcies. But I think there wasn't an idea of whatever it takes meant, how much it actually takes. So I think if we fall short of covering these temporary liquidity needs, the recession could become, as I said, much sharper and much more persistent. And there might also be some, spillover effects. We know from the 2009 and then, in Europe, the 2011 and 12 sovereign debt crisis, first the financial and then the sovereign debt crisis, that there are spillovers in terms of aggregate demand externalities, input-output relationship between firms, and also financial contagion, meaning that if a firm goes bankrupt, it's going to pay its customer, its suppliers, so it's going to spread contagion. And even if banks get again full of bad loans, that's going to be a problem. Although I think in this phase the banking sector is much better equipped, and the policies that have been put in place are much better to make sure that finance is not as fragile as it was during the previous two recessions.
So your method estimates how many firms have these liquidity problems at any time. How does it work?
So it's a very it's a very simple method, and indeed I think I'll teach it in my basic introductory microeconomic class in next spring. It's based on three main ingredients. The first one is to have the initial stock of liquidity of a firm, and that's where the firm starts from. And then you need to have the estimate of the evolution of the cash flow month by month. So that's just what the firm earns by selling its goods and products minus the payments, the outflows. And then you just use the budget equation for the liquidity evolution. You start in February with a 500,000 liquidity, and then it turns out that in March your demand drops by a lot, your costs drop, but not by as much, and you may say 100,000 losses. Your liquidity goes down to 400. Then in May, something happens again, maybe it goes down to 150, and at some point your liquidity disappears. And that's when I say that the firm becomes illiquid. So you basically need demand, cost, and the initial stock of liquidity.
Well, it sounds simple enough, but of course you need data for this. So how did you get hold of this data? Where does it come from?
So the data, okay, you need two essential data types. The first one is firm accounting data. And in firm accounting data, you have both the liquidity stock the firm begins with and historical data, or say, I don't know, 2019 data on sales and costs. So that's the stuff that actually, to me, was provided by Cerved. But these data are actually available in many countries, and there are data providers that actually supply consistent data across countries, and they have been very, very commonly used in research. So the second element that you need is an estimate. In my case, was at the sectoral level of sales drop, demand drop, and that was also provided to me by Cerved. This is the stuff which is harder to get by because we know how to use balance sheet data, but understanding how much sectors are affected by the pandemic requires some sectoral expertise, which is something that not many economists have. But Cerved is it's a company that provides banks with firms credit ratings. So their customers were asking, then you have to tell us what sectors will actually record the largest drop in sales, and so their experts had to sit down and figure out this sectoral evolution of sales, pretty much the sales drop, right? And so once you have the initial liquidity, you have the evolution of sales. What you still miss is the evolution of the costs to get the cash flow, and that's where economics comes in because what I did, I actually assumed that there is an elasticity between what you sell and how much you spend, right? And this elasticity, then it depends on the specificities of single countries. In particular, we have to take into account that this happened in a very short period of time. So maybe costs are not as reactive to sales as in the long run. For example, you might have, you have to pay your rents, and you might take some time to renegotiate them if they let you renegotiate them. But also there are policies that country different countries set in place to actually alleviate these costs. For example, in Italy, there were two important policies that I had to take into account. The first is that all financial payments were frozen, so both interest payments and also mortgage rates were frozen. So that meant that I had to shut down any sort of cost of capital outflows, and also the government supplied firms with a sort of a wage supplement. So basically, the government said during this period we are going to pay any, if you have your work partially lay off your work, as you say, you work part-time or maybe you don't work for a month, they are totally going to be paid by the government. So that meant that for firms was very easy to respond to drops in sales with a drop in labor costs, because those costs were actually borne by the government. This wouldn't be typically the case in normal times, because we know that labor costs are not very flexible in the short time. But I think in this specific episode, it was important to take into account these policies. And I think this is also policies that has been used in different countries.
Now, you ran these numbers in the early stages of the pandemic. What did it tell you about how many firms in Italy were running out of money, and therefore the impact of the Italian liquidity decree? Well, that's what it's called, isn't it?
Okay, so now we get into the, I constructed this machine and then I applied it to a database of basically it's all the incorporated businesses in Italy. It's like almost 700,000 firms accounting for more than 2/3 of private sector GDP. So it's the bulk of the Italian private economy. And so I'll tell you, we did it two different scenarios, like a benign one where the pandemic reaches a peak in April, but then little by little goes down, and there's no coming back in fall. But then we also have a more pessimistic one. But let's talk about the basic one. Hopefully, we all hope that this is the one that we have to be worried about. But we have the numbers also for the other one, and maybe I'll tell something. So I can show you a couple of figures that I think are going to be very explicative. So here in figure one from the COVID economics paper, I plot the number of firms that become illiquid month by month. The computations I told you were done by month because we had monthly estimates of sales, right? So, and as you can see, the pandemic kicks in very quickly. Already in March, we have around 100,000 firms turning illiquid out of less than 700. And in April, the number is 180,000. And it peaks more or less at 200,000 firms in September, and then it declines, but very, very mildly until the end of the year. So these firms are actually at peak involved around 3.5 million workers, and that's around 12% of the Italian workforce. So we are not talking about peanuts. So another interesting piece of information is how much, we were saying, how much does it take, as I was saying in the beginning, because now what I can do, I can actually, as I was saying, so the numbers I gave you are about firms which liquidity goes to zero, right? And then if it goes to zero and you keep accumulating losses, you will actually build up a negative liquidity somehow, right? Those is what I call liquidity shortage. You get to zero, and then you make 200,000 euros losses, say, and then you have 200,000 of liquidity shortage, then 100,000 more, etc. So I summed up all these monthly liquidity losses, and I computed the cumulative numbers, and it turns out, and this is shown in figure 2 in the paper, it turns out that the liquidity losses in the beginning are around 7 billion in March, and that's because despite the fact that there are many firms turning illiquid in March, they are mostly very, very small firms, right? But then as time goes by, bigger firms kick in, and already in April, we talk about 40 billion euros, and at peak, we reach around 70 billion euros of liquidity losses. So this is a big number, but I have to say, when I saw this number, I thought that it's a manageable number, right? Because we are not talking about, 70 billion for Italy would be like around 4% of GDP, something like that. And remember, these are liquidity needs. So the fact that the government offers a guarantee, it doesn't mean that the government is just putting 70 billion. Actually, the numbers that the government uses to compute the costs, of these guarantees is around 10% of what they actually guarantee. Meaning, it's based on the default rate. There is an expected default rate, which is, which it's hard to predict because it depends on how the pandemic will go. But they actually set apart around 10% of the total guarantees. So it was this, according to these numbers, it would be sort of a 7 billion cost to cover these liquidity shortages, which is less than 0.5% of the GDP, and even the plan that has been approved yesterday of the European level, it doesn't seem like a big number. So my starting question, how much does it take? Can this policy be credible? I think the answer we get from these numbers is that it can be credible because the numbers that are implied are actually are numbers on which government policy can act.
While the policy might be credible and you could put a lid on the numbers, there is still the practical problem, isn't there, that there are potentially hundreds of thousands of firms that need to be helped, and they need to be helped quickly as well. Can we do anything to speed up that process?
Yeah, that's an excellent question. It goes, now we are going deep into the policy. So again, I used the Italian government guarantee to understand, to somehow see if it was offering sufficient theoretical coverage, and also what might have been the problems for this theoretical coverage to actually become practical coverage. So it turns out, the Italian government guarantees, I won't go into the details because maybe, every country has different details, but I think the general picture, the general scheme is always going to be something like the Italian government one, meaning that you typically give little amount with full guarantee and very quick procedures, okay? But then as firms require more and more money, bigger amounts of money, then the procedures become a little bit more complicated, meaning that maybe the government has to also approve the loan. For example, in Italy, there is a 30,000 euros guarantees, which is supply 100%, no questions asked. That's very quick. So banks just give the money, the guarantee is complete. But then as the amount of money increases, the government starts saying, okay, we are going to guarantee only 90%, and maybe above a certain threshold, 80%. And then they say, and the loan must also be approved by a governmental agency. What I did then, I looked at the coverage according to the different type of measures. The first one, the second one, the third, and the fourth. There are different types of measures. And it turns out that the first two are very quick, but they only cover less than half of the liquidity needs. So that means that if we actually count on semi-automatic measures, that's not going to be enough. We need the more sophisticated measures to kick in. But then, as you were saying, there might be a problem of, 100,000 loan applications flooding banks and flooding also the government agency. And that might actually slow down the process. And so now we need to make sure that the process becomes fast. And what we do in the paper, we propose a possibility to use a method where you actually first screen firms only based on credit scores, right? All these firms have a credit score. There are different agencies supplying these credit scores. And if the firm has a very good credit score, you actually give the loan, because it means that it's a firm that was very healthy before the crisis. Hopefully, when the crisis is over, it will go back to being healthy and they will be able to repay the loan. But then there is a share of firms that were already troubled before the crisis. And in that case, they might be troubled because they are zombies, or they might be troubled because they had some temporary problems. And that's where banks should actually focus their screening abilities. So our proposal is to have a two-step procedure. First, you screen firms based on quantitative methods, and those that are solid, you give the loan quickly. And then the ones that instead, the quantitative method turns on a red flag, you say, now we are going to analyze more seriously if these firms are actually viable, or maybe if it's not really worth lending money to them.
Were you able to find out anything about the impact of a policy like this, the different impact of a policy like this on small firms and large firms?
So yeah, I mean, in the figure that I showed before, there is a distinction of demand for money in terms of small, defined as less than 500 employees, and we use 500 because this is actually the size, the per employees threshold used by the Italian government in defining the different guarantee measures. There is a preferential access to small firms. And it turns out that first, small firms are actually expressing the bigger demand for a guarantee, for liquidity, for loans, because they have the biggest liquidity problems. And also, experience teaches us that small firms are in general more fragile. They have a harder time finding money by themselves. And it turns out the experience of the Great Recession has also shown us that they are more fragile vis-a-vis large firms in intra-firm bargaining, meaning that what we saw during the Great Recession, when bank credit dried up, we saw that actually large firm increased the days that it took for them to pay customers, to pay suppliers, and ask them the money from their customer quicker. So somehow they have a stronger bargaining position. So somehow they drain liquidity. They tend to drain liquidity from small firms. So small firms are more exposed both to the liquidity shock, because typically they have less liquidity and they have less alternatives to make up for it. So I think most governments gave a preferential treatment to small firms with these guarantees. In general, I think that too many policies that favor small firms might keep firms from growing. But I have to say, in this case, the evidence suggests that it's a good idea to have a preferential avenue for small firms in accessing liquidity and loans.
As you said before, Fabiano, there are many countries that collect the statistics that you need to do this. So can policymakers everywhere, well, I mean, can first year economics students everywhere use this to do the calculations for their economies?
Yeah, I think they can. And indeed, I circulated the draft very early on, and it received quite a bit of attention from different policy institutions. Central banks, for example, were very interested, both the Bank of Italy, but then I gave a talk at the ECB, and I think they replicated my study on a data set with many countries. And also the OECD has done the same. They also used these international data sets to replicate my numbers. And I think with different assumptions and, but in general, I think the picture that emerged was very consistent across countries, that there are, liquidity shortages going on, but they all seem manageable. And so, there's no excuse not to actually take care of them.
Mm. And that also means that the fear about a large amount of lending being done to zombie firms, is that overstated?
So, I've done some work on zombie firms, and it turned out you know, my answer will be in two parts. First, how much of the lending would be going to zombie firms during this crisis? So, in another paper that I wrote with Guido Tabellini of Bocconi and Enrico Sette of the Bank of Italy, we actually focused on that specific question. It turns out that not a lot of credit demand comes from zombie firms. We have a definition of zombie firms which is based on credit ratings, but it's sort of a standard definition of not viable firms. And it turns out that according to our calculations, only 10% of liquidity shortages comes from these firms. And the reason is that, of course, there are not, thanks God, there are not so many, but also this crisis has been somehow orthogonal to firms' characteristics. What caused the crisis was like, technological and demand factors. For example, restaurants and airlines, their businesses went almost down to zero, but it had nothing to do with how good or bad they were. So it was very, it was determined by other reasons. Of course, zombies are more fragile, but in general, this has been a crisis that in a sense has been sort of democratic, has been eating firms very much independently from their financial conditions, but based on what type of goods they were producing, so the demand, and also how they were producing it because of the distancing needs, the capacity to work, remotely or not, etc. So so we find that actually zombie lending in this particular episode doesn't seem to be that central. But most of the credit demand would actually come from previously healthy firms, and hopefully firms that will be healthy soon again. And the second reason is that from a more general perspective, we have done some work where we actually find that the statement that the literature fairly not large, but there are a few papers saying that zombie lending actually hurts the recovery because it slows down the expansion of healthy firms. And we, I'm not going to go into the details, but we have some evidence that suggests that that statement too might be a little bit overstated in general. So, if we put these two, pieces of evidence together, I would suggest that zombie lending would be sort of a second order concern. If you had to tell me a year from now, if the only program that will be left after this crisis and after all these guaranteed lending that we do to firms will be that maybe some lending had gone to zombie firms, I would actually be very happy, in the sense that if we have saved the healthy firms, I think it's a price that's very worth paying, because I think it's not going to be a very big price.
But a first order concern, and it was one that you mentioned right at the beginning of this, is what happens if there is a second wave of infection and these lockdowns return and demand falls again? What do we know about the outcome for firms in that case?
So we have done also like a more pessimistic outcome. We all hope is not going to happen, but at the end of the day, I mean, it's hard. First of all, it's hard to tell exactly how it will play out. But eventually, what we found is that even under a more pessimistic scenario, the numbers would go up. We would go, we would actually, our numbers that we were talking about 70 billions of liquidity shortages, we would go above 100 millions. So, and some of these firms will actually might become from illiquid also insolvent, because if you keep adding losses at some point, even if you were healthy before the crisis, you might become insolvent anyway, and they might decide to shut down independently from illiquidity. But in terms of liquidity, I think the numbers are still manageable. Also because hopefully we have learned a little bit to deal with the crisis. So hopefully the hope is that even if it comes back, we will be able to deal with it without having to completely shut down the economy for months. But social distancing, the measures we are taking to reduce the spread of the pandemic might actually help us to limit the effects compared to the first wave. Of course, it's going to be tough, and who knows? I mean, we hope we don't have to find out. And I'm focusing on a specific aspect, which is the one of liquidity. But in terms of liquidity, I think that even with the second wave, the instruments that are on the table should be sufficient to deal with it. With all the other problems, I don't know.
Fabiano, that's fascinating. Thank you very much.
Thank you. My pleasure.
Now, the paper we have been talking about is in COVID Economics 35, and its title, let's get it right, is A Simple Method to Estimate Firms' Liquidity Needs During a COVID-19 Crisis with an Application to Italy. And the authors, of course, Fabiano Schivardi and Guido Romano. Keep in touch with all our COVID-19 coverage at VoxEU. There's loads of it, and there's more every day. And tell us if you want us to cover something, and we will for you. But meanwhile, from Fabiano and from myself, from all of us at the CEPR, as we always say at this point, stay positive, but stay negative.